Hi, I'm David Stein of Money for the Rest of Us, and in this video I share with you how to spot investment fraud. Investment fraud. This is individuals that take advantage of other individuals. Sometimes in the form of a Ponzi scheme, they just steal the money. Sometimes they overcharge in terms of fees, or sometimes they're just not clear about conflicts of interest. We need to be wary of potential investment fraud. Here are some red flags. First, oftentimes Ponzi schemes or other frauds are friends or family members of the individual being taken advantage of. It's nice to have friends and family members, but we should always look and see, who is this person? Are they registered with the proper authorities? As investment advisors, they need to be registered with the Securities and Exchange Commission in the US or other regulatory authorities in other countries, or with the individual state. If they're a broker, they should be registered with a broker-dealer. You can check up on investment advisors or brokers by going to advisorinfo.sec.gov. There you can search for individual advisors or firms, or you can go to brokercheck.finra.org, and if it's a broker, you can see about past enforcement actions or client complaints. So we need to understand who these individuals are. If they're selling securities, they should be registered with some entity, be the SEC, the state, or with FINRA. The second thing we should look at then is the particular investment opportunity. Is that registered? Is it a registered security? Or is it a registered investment company, such as a mutual fund or an ETF or a closed-end fund? Not all securities are registered. And if it's not registered, we should be more wary and read through all the documentation, the offering memorandum, to understand what are the risks of this particular investment. Before we invest, we need to be able to understand what the investment is. What does the advisor, the individual, the manager have to do in order for this investment to be successful? We need to understand those return drivers and be able to explain them. If we can't explain the investment, then we shouldn't invest. What about performance? Is the individual promising performance that seems unrealistic? 15, 20% type returns? Is there a performance track record? And if there is, has that record been audited or verified by a third party, an outside accounting firm? As an institutional investment advisor, we had our track record audited or verified by an outside firm to say this composite return was correct. It was done correctly. We should also, in terms of performance, understand, is it hypothetical? Is this made up numbers or a back test, or is it real? It's very different investing live money than it is doing a hypothetical back test. We should also look at the fees. How much does this investment cost? Because that will come out of the gross return. And if you already hired an advisor, you have a broker, you should occasionally look at the fees that are coming out of your account to make sure that they are the amount that was promised. So those are some of the things that we should look for as individuals. We should look at, is the individual registered? Is the security registered? If it's unregistered, read through the documentation, understand what the investment is. What does it take to be successful? What about the performance? Is it hypothetical? Is it real? Is it verified? And are the fees reasonable that we're being charged? That's what we can look for to avoid investment fraud. If you have any question on this, or you have suggestions for future topics for the Money for the Rest of Us channel, you can leave those in the comments below. Thanks.